Thank you, ladies and gentlemen, for coming. For those of you that don't know me, my name is Jonathan Wu. I'm the head of distribution and operations for PremiumChina, but I think you've either heard of me or seen me speak on numerous occasions. This is the feedback that we got. Now, ladies and gentlemen, I'm not trying to sell you the study tour as a product. Okay? This is not what I'm trying to do. I'm trying to sell you the China tour as an experience. Right? For most of the guys that are sitting on that table, I think, were all on a tour last year. We didn't funnel you just information about our funds. We gave you experiences about companies and culture and food. Right? All of those things that you want to experience when you normally travel. 95% of participants said that they would recommend someone else to go. 91% said that it changed their view on China. Okay? We don't plan to run one this year, but we plan to run one in 2014, so watch this space. And if we can get that type of accreditation year in, year out, then you've solidified your whole year's worth of learning in one trip. Now, something that I've always wanted to say for many, many years, comes a little bit of a tech junkie, is that about an iPad. We have decided to launch an iPad app. And this is another resource to assist you in educating your clients. Now, I tested this a bit earlier and this worked, so let's see. All right. This is a free app on the App Store, and it was available from Monday. And why have we called our presentations this year the reasonable basis of Asia? Because, as I said, we've been an information service, but you have lacked the tools to take to your client to implement our funds. Okay? You have mentioned to us that you've given us a lot of information, but I can't communicate most of that to my clients. So in a new FOFA environment, reasonable basis is getting a lot more important. We have realized that, well, firstly, the government has realized that Asia is important in this new century. The mining investment boom is over in Australia. Okay, so we aren't linking China to Australia only from a mining perspective. Thirdly, Australian equities aren't exactly the cheapest, okay, and they are currently in a phase one bull cycle, as some fund managers like to say, but it's a profitless growth path. As you understand, all the money's gone back to the share market, but none of that's gone back to the real economy, which means there's not actually really great results. Many dealers have either held their conference in China or they're planning to. So as I understand it, PIS plans to run one next year. Financial Wisdom's been, Count has been, a lot of dealers. Lonsdale had theirs last year. Okay, so a lot of you have seen China. We have a lack of growth from Western economies, which is what we keep talking about. Can US equities simply keep rallying? I'm still questioning that today because they're on a 9-day winning streak, which is incredible. And where you're going to see the next decade to come. Okay, so that's those key points why we're talking about basis today. Asia's GDP hasn't changed very much, and no matter whether you invest in a China fund or an Asian fund or an EM fund, your largest allocation will be looking at China. That's not because we benchmark ourselves against this. Don't get me wrong, we're not benching ourselves against a GDP chart. We're just saying the largest impact to Asia's growth will still be China for the foreseeable future. This is a decoupling chart that we present to you every year. And Alan, who's one of our senior fund managers, which presented here last year, is going to talk to you about some changes in the market fundamentals, which will hopefully bring about less volatility in the market. Because at the end of the day, if advisors have any concerns about China, the first and foremost is volatility. Okay? But over the full decade, even though in the crisis situations Asia doesn't do very well, over the whole decade it outperforms. This is indices only. Indices only. Asian companies are not smaller, ladies and gentlemen. This is another feedback that we've gotten. But they have no bleeding idea who China Vanke is. And I'm sure most of you in the room also don't know who China Vanke is. It's double the size of Westfield. It's huge, okay? But no one understands it. It's a developer. Other examples, we have banks in China much larger than Australian banks. We have telecom companies much larger. Yes, we don't pay 28 cents a half year on the Telstra dividend. We also have PetroChina, world's largest, or I think world's second largest diversified miner. a wine company that's larger than Treasury Wines, and we have home appliance companies, the same business model as Harvey Norman, that's many times the size. Okay? In the last 12 months, Australia's contribution to the world capital markets have shrunk a little bit. It's gone from 2.6 to about 2.4%, and China has remained steady, sitting at that greater China portion, which is the 7 plus the 5 and the 1% in Taiwan. All right? 7 plus 6, 13%. Our fund managers are at the top of their game. We have 39 members in our investment team. 2 of them are here today, and they are both senior fund managers. It is very rare that we have 2 senior fund managers actually leaving the office, because remember, these guys are trading every day. And every time Alan's here, he's in front of his laptop or his BlackBerry putting trades in. So we have 2 people that are directly responsible for our funds. Their investment philosophy is deep value, nothing else. They are picking stocks that are not recognized by the market. Now, in a real context, something that you can put in your frame of mind is that in times like this is when we outperform. When markets recover, when fundamentals recover, is when we outperform. Times when we don't outperform is something like first half of last year. We buy cheap stocks that became cheaper. Second half of the year, we saw that whole recovery situation. US said, I'm going to print unlimited money for an unlimited amount of time. That's when the market turned, and that's when our fund turned. So 6 months ending January 31st, our fund has done 31%. But we'll break that down for you a bit further on later on. Our CIOs are the same as the CIOs when they started the business in 1993. Okay? And they are a listed asset management firm in Hong Kong with $1 billion of market cap, and half of the listed equity is owned by management. So these guys stick together. They have won endless amount of awards, okay? And even though they're not well known in Australia, they are well known in Hong Kong as the best of the best. And the reason why they're the best of the best is because they have an annualized compound rate of return at 17.1% per annum, net of all fees to client. These are figures ending January 31. 17.1%, with the lowest volatility in the market. Okay? And if you are still considering buying an index, and I harp on this year in, year out, you will get a 0% return for 20 years. With the highest volatility registerable. In the 8 years that PremiumChina Fund has been around, we have lost 2 senior fund managers. There have never been a situation where a research house has downgraded us. Why? Because we have so many senior fund managers. Because we diversify away our key man risk. And our fund managers have been with us for a very long time. Okay? Alan, who is in his 11th year with Value Partners, and Michelle, who has spent her whole career with Value Partners. So it's a very, very strong team. We have no star manager. No star manager. It is a team effort or nothing. That's the way that we approach things. So that's the only sales pitch I'm going to give you today. And the first person we're going to have on stage is Alan Wang. Alan presented last year, if you were here at our roadshow. And Alan is a senior fund manager. And from what he tells me, he's ranked somewhere about number 5 in the company by hierarchy. He hopes. And as I said, he's been with Value Partners for 11 years. Alan is actually Australian by background. I know he looks Chinese, guys. Just like me, but I'm Aussie by background. We're just born this way. Is that Alan spent 20 years in Australia. He was brought up in Australia, and he worked for Macquarie Bank when they first started doing property transactions in China. So Alan then returned to Hong Kong and has spent the last 11 years with one employer, Value Partners, and working his way from being an analyst all the way to being a senior fund manager. So to give you a context, Alan is actually the person that looks after the Premium China Fund day to day, so he understands the portfolio exactly inside out. And Michelle, who will speak later, is the one that looks after our property fund day by day. So what Alan's going to do for you this morning, as well as Michelle, is give you 4 bases. Michelle's going to give you 2, Alan's going to give you 4. The bases are this simple. The way that we design the basis is that you can deliver the exact same message to your client, because it's not hard to understand. But with every one of these examples that we provide you, we give you a stock example of exactly what we bought, okay, to capture that theme or that basis. Within your packs, as I said, there's a Why China, Why Now piece, and that is the first piece that we brought out that links these 4 themes on a 2-sheeted piece of paper that you can deliver to your clients. Also, we'll be delivering SOA inserts for you from our website in a new section called Reasonable Basis, and you'll receive information a month from now with all that being launched. And you'll be able to copy SOA inserts directly into your SOA documents. The reason why we can provide that is we're a financial advice firm as well, so we're doing exactly what you do. So we're giving you as much tools as possible to allocate, especially given we are in a new market cycle. So without further ado, I pass you to Alan.
All right, thank you, Jonathan. It's good to see many of your familiar faces here. Obviously, for those who've been to the China Study Tour last year, might have met me already. So just very quickly about myself. I grew up in Beijing, came to Australia when I was very young, and basically, did high school and university here. Since graduation, I worked for Macquarie Bank for 5 years, but also on the China team doing investment on property side for the bank in China. And about 2003, I went to Hong Kong and started working for Value Partners, and I've been doing investment in the Greater China equity space for the past 10 years, and this is my 11th year with Value Partners. Well, like Jonathan said, I think that most of you within this room are obviously professional investors, and you understand a great deal about China already. But the key is how do you translate your views on China to your clients, who are the ordinary citizens, the mom and dads out there. And obviously, they are influenced by what they read in the press. Sometimes, I wouldn't say, it's non-factual, but sometimes the press does tend to exaggerate things in order to catch eyeballs. So I'm going to present 4 bases today from 4 different perspectives. One from the macro perspective, second from a share class perspective, and the third and fourth from a cyclical as well as a consumption perspective, respectively. And hopefully, those bases were able to help you to convince your clients at least to take a serious look at China and the investment opportunities there from a factual perspective. First of all, what is the macro outlook of China for 2013? We are in the camp that believes that China did not experience any hard landing in 2012. If anything, China experienced a soft landing. And from macro situation, the worst is beyond us already. China experienced 3 quarters of very negative economic environment during the early part of 2012. But by around end of the 3rd quarter and early 4th quarter last year, we believe that the economy has bottomed out. Anecdotally, looking at various types of economic data beyond just what you read the headline GDP, you will see that power consumption in China has already bottomed out and started recovery in the 3rd quarter or 4th quarter of last year. And this is a chart that you can see on the left-hand side. Similarly, based on the PMI, both official as well as the HSBC one, we have seen an improvement of business sentiment. Remember, PMI data is based on surveys of managers of various types of businesses, both the larger SOEs as well as the smaller and medium enterprises. So based on those surveys, we do see that business sentiment has improved for 4 to 5 consecutive months since the 4th quarter of last year, which they have been above the 50% threshold level, which shows the expansion of the overall economic activity. What has contributed to the worst the weak performance of Chinese economy in the first 3 quarters of last year was destocking of inventories. China, in a way, did help the rest of the world to pull out a global financial crisis in 2009 by introducing a very large 4 trillion renminbi fiscal stimulus. But that's without consequences. That very big fiscal stimulus did result in overcapacity in many of the sectors within China. And once you have overcapacity, it does take time to digest of that excess capacity as well as inventory. So throughout the later part of 2011 and the first 3 quarters of 2012, China went through what we call a destocking process among many of its sectors and industries. That destocking process has gradually come to an end towards the end of last year for many of the sectors, and we see some of the sectors start to restock a lot of the inventories in order to replenish for future production. One evidence is that it's a steel sector. And the restocking by steel mills resulted in a very sharp rebound in iron ore prices. I'm sure that all of you are aware towards the end of last year. But of course, this is not uniform across all the industries in China. For some sectors, such as the construction machinery sector, for example, we still see a lot of inventory in the distribution channels. So the picture is still very mixed. Based on that, we believe that the current economic recovery in China, if anything, is a weak recovery rather than a very sharp V-shaped type of recovery. Just like economic data out of the US, economic data out of China is also quite mixed. There are both some good ones as well as some weak ones. And we do believe that this year, GDP growth will be slightly higher than last year. But by no means we are outright bull on China in a big sense. Looking at the capital market, one thing that has helped Hong Kong market in particularly in the last quarter last year was liquidity flows. The Hong Kong equity market is very much integrated with the rest of the world. You do see a lot of global investors through international funds, global funds, as well as regional funds that invest and allocate to Hong Kong and indirectly to Chinese equities. And towards the end of last year, we have seen very strong liquidity flow into the Hong Kong capital market. And you can see from the chart on the left-hand side, where there's a big spike towards the end of the last year. And that evidence that shows the liquidity flow into MSCI China Index. Another good thing is that sell-side brokers from the world's large investment banks, whether it be Morgan Stanley, UBS, Credit Suisse, or even Macquarie, has also turned slightly more positive after 3 consecutive quarters of earnings downgrade for corporates and research coverages. Towards the end of last year, we have seen a positive uptick in the amount of overweights and buy recommendations issued by these sell-side brokers. And that also is the evidence of that corporate profitability has now turned the corner and is improving into 2013. So overall, we believe that the investment environment from a macro perspective, at least in 2013, will be a lot better than 2012. But there are also risks associated with the macro picture. And the biggest risk of them all is inflation and asset prices. The current inflation level in China is not very high, below 3%. I think it's about 2.2, 2.4% in that sort of range. So it is still very much manageable in the current state. But that's not to say that inflation doesn't pick up sometime in the future. Based on our own analysis, as well as talking to various economists and strategists, we do believe that there is the pressure for inflation to tick up in the second half of this year. Now, of course, if that occurs, the central bank will might likely to turn its current prudent monetary policy towards a tighter stance. And that obviously will lead to a shortened economic cycle recovery. Similarly, property prices, which has not been a major issue up to date, where the average property prices has only gone up by less than 1% in China, might have more pressure to go up in the second half of this year. And it's like property prices anywhere in the world. When prices goes up too fast, it becomes not just only an economic problem, but also becomes a social and political problem. So the government wants to keep a lid on the amount or the magnitude of the property price increase. My colleague Michelle Yu will talk about property sector in more detail later on. So those are some of the risks that we need to keep an eye on. But the good thing is, the Chinese government will have a much more fiscal spending this year compared to last year. Last year, the total spending, the total budget deficit by the central government was 850 billion renminbi, which is about 1.5% of Chinese GDP. This year, under the work budget by the central government, which was just delivered a week ago, the new budget deficit target for this year is 1.2 trillion renminbi, or 2% of GDP. And we believe that a lot of those extra spending will go into infrastructure projects, as well as much needed education, healthcare, retirement, things like that. Much more needed social safety aspect as well. This slide just shows some of the longer-term reforms under the upcoming new government. We know that the Chinese Communist Party had an election of new leaders in October last year. In the current Congress happening in Beijing right now, they will elect the new leaders of the state. So they will vote and elect the new president of China, as well as the new premier for the state council. We believe that these are some of the potential long-term reforms that the new leadership will carry out over the next 5 to 10 years, which is 2 terms of office. But of course, the timing and magnitude of this reform is very difficult to gauge at the moment, but we do believe that these are some of the much-needed reforms that China will need to take in the years to come. So for investors or anyone who has interest in China, I think certainly this is one aspect that you should keep an eye on. So how do we invest in the current sort of macro improvement situation in China, given that it is a weak recovery, but yet the overall investment environment will be more favorable than 2012? One company that we have invested into is a company called Minsheng Bank. Almost all of the banks in China are state-owned, particularly for the very large one, with exception of one bank, that is Minsheng. Minsheng is a privately owned, in the sense that not majority owned by the government, but the major shareholders are all private entrepreneurs. This bank focuses more on the small medium enterprises as its key customers, as opposed to large SOEs or large infrastructure projects or local government financing vehicles. So it has a very different clientele base compared to the larger SOE or state-controlled banks. But in our opinion, this bank was unwillingly punished when people had negative views regarding the Chinese banking sector about a year ago. Back in March 2012, Minsheng Bank was only trading at 0.6 times price to book, with an ROE of 16–17%. And we think that this bank was trading at very low valuation. Even if one were concerned about the state bank's exposure to various types of SOEs or inefficient state sectors or infrastructure projects, we believe that Minsheng Bank's exposure to small medium enterprises should justify a much higher valuation. So we start to accumulate Minsheng Bank throughout the second and third quarter of 2012 with an average cost of about $7 per share. The bank's share price did have a very strong dip back in about September, October last year, but that was more to do with the overall global situation back then. But since then, you see that once people's investment sentiment or confidence returned to a more normalized level, Minsheng Bank's share price significantly outperformed those of the large state banks. It's now trading close to $11 per share. And we held just under about 2% exposure for the PremiumChina fund in this particular stock. Right now, the bank is trading at around 1 times price to book, and again, with a mid to high double-digit teen sort of ROE. We like this bank for for its exposure to the non-state sector, and we believe that longer term, this bank is a winner among the banking sector in China. So this is one example of how value partners pick stocks for the PremiumChina fund when everyone else are concerned about China. We see the value and the opportunities. Now let me turn to the second basis, where we see arbitrage and converging opportunities among the different share classes in China. For those of you who might not be that familiar with the different type of share classes, I believe that the iPad app that Jonathan has created has a detailed description of the different type of share classes of Chinese equities. But just very simply, we call the Hong Kong traded Chinese shares mostly as H shares. And we call the domestic traded Chinese equities in the local Shanghai Shenzhen stock exchanges as A shares. Historically, the A shares were traded at a much higher premium compared to the Hong Kong listed H shares because the domestic equity market was much more retail, momentum, and thematic driven. But over the past 3 years, the A share market itself has derated because sentiment in the A share market itself has been very, very poor due to fear of supply of new shares through IPOs. And you can see that currently, the valuation of the A share market versus the average valuation of the H share market has narrowed down to only about 10%. So we do see a lot of opportunities emerging in the A share market today. And just to give you some perspective, there are some companies that are both dual listed in the A share market as well as the H share market. And right now, there are about 20 of these dual listed companies where the A share is trading at a discount to the H share counterpart. The discount be as much as 20%. Yet the shares have the same voting right, the same corporate action right, the same right to dividends in the same company. So for investors, if you could, why wouldn't you invest in the cheaper of the two share classes? So we see opportunities in many of these dual listed companies where the A shares do tend to trade cheaper than the H shares. But access to the A share market is an issue. The A share market is still closed off to most of the foreign investors because of capital control in China. Since 2005, the Chinese has issued what they call the Qualified Foreign Institutional Investor, or QFII program, to foreign investors. Foreign institutional investors need to apply for QFII license and then apply for QFII quota in order to invest into the A share market. Right now, the regulators has given out a total of $38 billion of QFII quota to global investors, of which 18 billion was given or awarded in 2012 alone. So you can see that the regulators have really sped up the process of awarding QFII quotas to global institutional investors. And that's their means of opening the market to foreign investors faster. Similarly, China has also launched what they call the Renminbi Qualified Foreign Institutional Investor Program last year, or RQFII for short. The RQFII program is designed to attract all those offshore renminbi that are trapped in Hong Kong, which in the hundreds of billions, to channel them back into the equity market within the mainland. And that RQFII program has already amounted to $8 billion within a period of 6 months. So we do see that more of this opening up happening in China by the regulators to attract foreign investors to invest into the A share market. And we have seen a lot of interest from foreign investors in just doing that. Value Partners launched a dedicated A share fund through our own QFII license about a month ago. And we raised $50 million within a matter of 1 week only from US and European investors. So we see the opportunity in the Asia market, and this is the pace of the growth of the Asia market. This chart shows how many IPOs in terms of number of companies that has been occurring in the Asia market over the past few years. Of course, this is both and good. The good side is with more IPOs, it really adds to the depth of the market. More opportunities, more companies that you can invest in, the universe grows bigger. But the downside is that it sucks away a lot of liquidity. IPOs take liquidity away from existing shareholdings. And that has been the very negative structural negative factor that has resulted in the derating of the Asian market over the past 3 years. IPO was happening at a rate of about 350 companies per annum between 2009 and 2011. Right now, there are just under 800 IPOs in the pipeline waiting to get listed. So the regulator need to figure out a way, how do they manage the 800 potential IPOs? They need to pace that. If all 800 IPOs come at the same time, of course, the market liquidity will have a very negative impact. But we believe that, since the fourth quarter of last year, you can see from the chart, there has been no more new IPOs in the Asian market. This is one good thing about being a communist country. The regulator can do whatever they want. When they say there's a danger of IPO threatening the market, they can simply stop or suspend the IPO for some time. So we are hopeful on the Asian market because the depth of the market is there, and we do expose ourselves, which I'll come back to later, for the PremiumChina fund in the Asian market. But what we like and even more positive on is on the B-share market in China. The B-share market are stocks that are traded in the Shanghai and Shenzhen stock exchanges and have always been open to foreign investors. But the problem is the B-share market itself was an experimental market that was launched back in the early 1990s, when the government wasn't sure what's the best way to have foreign investors invest into Chinese equities. So they had the B-share market, as well as the ones that were listed in Hong Kong as H shares. And we know that over time, investors prefer the Hong Kong-listed H shares as the main market for investment, and more Chinese companies choose to list in the Hong Kong H share market as opposed in the B share market, or the domestic B share market. So right now, the B share market is more a legacy market with only 120 companies, and the market has not seen any IPOs or secondary share issuances since 2005. So this market is not growing and is neglected by most investors. For many global investors, institutional ones, they simply do not allow their global mandate to invest in the B share market because the market is not the depth is not good enough, the liquidity is poor, and there's only 120 companies to choose from. But we see a lot of value in the B share market. Because many investors choose to ignore this market, the valuation of this market is significantly cheaper than the H shares or the A shares. And Value Partner has been a big investor in B share market for more than 10 years now. The regulator understands that this market has served its function, its historical purposes, and it is their intention to get rid of all the B shares. Basically, they want no more B shares eventually. How do they do that? No one really knows for many years. Because the market is so small, it's not really on anyone's agenda as a top priority issue. There's just too many other things to deal with. The Asia market is 22 trillion renminbi in total market capitalization, while the B share market is only 200 billion, so too small to worry. But a breakthrough finally came in August last year, when one of the B share companies called CRMC, which is actually the world's largest container manufacturer, decided to put up a proposal to convert its Shenzhen-listed B shares into Hong Kong-listed H shares. Now you can see from the chart on the left-hand side, initially during the proposal period, the company's share price did not react much. But by November last year, when the company finally completed its conversion from B to H, suddenly its share price went up by more than 40%. Why? Because when the company was trading as a B share company, no one wanted to invest in it because it was a Mickey Mouse market. But after its listing as Hong Kong listed H shares, a lot of larger funds start to pay attention to this company because the market capital of this company itself is not very small, and many people had to have exposure to it, and the company will eventually get included in some of the indices as well. So there is this valuation opportunity. Before it was trading at a discount to Hong Kong comparables, now it's trading in line. So there really is a convergence opportunity here. We invested into a B-share company called China Wang, which is one of China's largest residential property developer. We have been investing in this company for well more than 10 years now, in and out, of course. The company's valuation trades at a discount to the Hong Kong-listed comparables, whether it be China Overseas Land or China Resource Land, some of the top-tier names in Hong Kong. This company was the second company that proposed to convert its Shenzhen-listed B share into Hong Kong-listed A shares. The company went to suspension on 28th of December and made the announcement in January this year about its proposal or intention. Since then, its share price shot up by 20%. Because again, as a B share company, it was trading at a discount to the Hong Kong-listed ones, but now people expect the company to finally convert into A shares. Its valuation converged in line with those ones in Hong Kong. This company accounted for 5% of PremiumChina Fund's exposure by the end of December last year. Now it counts for 6%. That extra 1% came from the 20% gain. And this is how we deliver outperformance for the PremiumChina Fund compared to the indices. We invest into asset classes and companies that are neglected by the rest of the market, where we do see an arbitrage opportunity over the longer term. Our PremiumChina Fund has done year-to-date growth of 5% as at the end of last Friday, and I believe the MSCI China Index was only up less than 2%. The next example I'll give you is on the infrastructure side. We like the railway sector in China for both the short-term benefits as well as the long-term implications. Of course, building high-speed railway networks in China adds to infrastructure spending, and more infrastructure spending adds up to GDP growth. So that is, of course, the short-term benefit of building a lot of infrastructure and high-speed railways, and that is good for the government as well as for the economy. But we also see the long-term benefit of having a better high-speed railway network in China. If you look at it, China is no longer cost competitive on manufacturing compared to many Southeast Asian countries. Wage is increasing. Utility cost is not cheap. Land costs are growing. But if you look at some of the Southeast Asian competitors, Vietnam, Indonesia, Thailand, they have cheaper labor costs. They have a younger workforce. Even utility cost is there lower because they have hydropower, for example. So we do see a lot of manufacturers either shifting the production base away from China into those Southeast Asian countries, or shifting the production base from the coastal regions of China into the inland of China, where costs are much, much cheaper. But the problem is, once you produce the goods in the inland part of China, how do you transport that out to the coastal regions where demand is based and where export, where all the ports are located for export? In the old days, Chinese railway system was based on the old Soviet model, very complex and sometimes extremely inefficient. And you have passenger trains and cargo trains all running on the same tracks. So by building a dedicated high-speed railway network that's dedicated for passenger trains only, you can free up a lot of capacity on the existing tracks for cargo transportation. And that will improve efficiency as well as productivity in terms of logistics. And that will help China to stay competitive over the longer term with some of the, competing against some of the Southeast Asian countries. So we think that investing into railway infrastructure is not just about FAI, fixed asset investment today, but it's also about the long-term competitiveness of the country. A second reason we liked about the railway sector, or more important, about the subways in China, is pollution. I still go to Beijing once a month to visit my family members there, And let me tell you, the pollution in Beijing is extremely bad. It's definitely no exaggeration based on what you see on TV. My wife and kids, they're there, my kid goes to international school in Beijing, and my wife tells me every day that we should come back to Australia. We shouldn't have our kids grow up there because the air is just so bad and really make your throat and your nose feel sick all the time. What can you do? On one hand, of course, you can replace coal-fired power stations with cleaner energy such as wind power, solar, nuclear, etc. Another way to reduce pollution is by reducing car emissions. To achieve that, of course, you need a better public transportation system. Beijing has a population of 20 million residents, a very large global tier 1 city by any standard. But its subway network or public transportation system is by far behind those of other world's large cities such as New York, London, Hong Kong, or Singapore. So they need to have more subways. Subways will lead to higher demand for subway carriages, trains, etc. as well. And ultimately, that will help, or at least one means to fight against pollution. So we have invested in a company called CSR, short for China Southern Railway. CSR is the largest producer of locomotive, train carriages, and associated or related equipment for subways and trains in China. We actually invest in both the A share as well as the H share of this company because at one stage, its A share was trading at a discount to its duly listed H shares. So again, we buy the cheaper of the two. And we believe that the demand for railway equipment is really long-term from both the high-speed railway perspective as well as the subway perspective. This company right now is trading about 12, 13 times earnings, so it's not that expensive. And at the same time, it does offer investors about 20% growth in earnings per annum. Finally, I'd like to share with you from non-cyclical perspective on why we like some of the opportunity in China. Healthcare, as we all know, is less impacted by the general cycle in economic activity. We still see a lot of room for Chinese to grow in the healthcare space. The spending by the Chinese government or by various companies and institutions in China in healthcare still lags far behind that of the many developed countries in the world. And even if you compare that to some of the developing countries, such as Brazil. So we think that there's definitely more room for healthcare spending growth. Also, unlike the US or Europe, where the large drug companies has a dominant market share in the marketplace, the drug companies in China are mostly small, medium-sized compared to by global standard. So they're much more fragmented. So we do see many of these companies are potential winners in the future, where they will grow very fast organically, as well as consolidators in the industry who will grow by mergers and acquisitions. And the room for some of these companies to ultimately compete on the international stage is actually a lot of potential. We also like the distribution subsector within the pharmaceutical sector, because ultimately you need to distribute out all the goods and drugs within the countries as big as China. So last year we invested in a company called Shanghai Pharmaceuticals. This is the second largest distribution company of drugs in China. It's a national player. And we put into this company in about July, August last year. And you can see from this price chart that in about June, July last year, the company's share prices fell off the cliff. Why? Because there was some concern within the marketplace about internal management changes within the company. People feel that the internal management change might detract the company's future growth strategies and reforms within the company. We have done a lot of in-depth research on this company. We talked to not only the senior management of the company, but also the middle managers among these various subsidiaries. We talked to its competitors, its upstream suppliers, as well as downstream customers about the company's strategy and future prospect. And we felt that the internal management change has very minimal impact on the company's future fundamental. So we took that as an opportunity to actually accumulate aggressively in the shares of this particular company. At the time, this company was trading only at 9 times earnings. And the average valuation for healthcare company in the Chinese equity space is between 15 and 20 times earnings. So we actually saw that as a very contrarian move to load up the shares in this company when the market disliked it. Our average cost in this company is about $11, $12, and right now the company is trading at $17. Since then, many of the investors out there realized that, hey, the internal management change didn't really impact the company that much, and the company's share price, as you can see, has actually re-rated quite strongly. Even today, the company still only trades at about 15 times earnings. It's much more expensive than when we first bought it, but at 15 times earnings, we believe that it's still very reasonable given that the future long-term prospect of the healthcare sector in China and the company's dominant role as the second biggest player in distribution of healthcare goods in China. And finally, just a very quick illustration of the current sector as well as asset class breakdown of the PremiumChina fund. Like I said, we're very hopeful on the Asia market, which we have 6% exposure to within the PremiumChina fund, and we're very positive on the B shares, which the PremiumChina fund has 13% exposure to. Our exposure to the various industry and sector is much more balanced. We have a balanced mix of consumption as well as cyclical sectors, cyclical sector exposure within the PremiumChina fund. We are much more bottom-up when it comes to stock picking. We don't have very much a top-down view as to which sector we prefer over the others, but it's more a bottom-up process where we will invest into the opportunities based on each individual company's merits. The PremiumChina fund has actually performed very strongly in the past 6 months in particularly, and you can see that we have outperformed the MSCI China Index. And finally, this is just to show the top 10 holdings within the PremiumChina fund. Some of the examples I have mentioned, like China Vanke, Shanghai Pharmaceutical, are within the top 10 holdings. And again, the sector representation of the top 10 holding is also quite diversified. I don't manage the Premium iShare Fund directly. It is actually done by one of my colleagues. The Premium iShare Fund is much more a regional focused fund. So it does have a lot of exposure in Southeast Asian economies such as Thailand, Indonesia, Philippines, where it has performed very strongly for the past 2.5 years. And this shows the geographic as well as the sector exposure for the Premium iShare Fund. And from the top 10, you can see that only 2 names, which is again China Vanke and another company called Shenzhou International, are Greater China companies. The rest are all non-Chinese companies. So for investors who prefer to have a regional exposure, the Premium Asia Fund is also a very good product. Johnson.
Thank you, Alan. So those were the couple of bases from Alan. So the other key distinction between Premium China and Premium Asia is that Premium Asia is unhedged. Premium China is partially hedged. Just to make it simple, it's 50% hedged. Okay?